All right, guys, let's continue on with Free to Choose. Free to Choose. Chapter 3, The Anatomy of Crisis. This subchapter is called The Origin of the Federal Reserve System. And it's a little bit long, longer than I really wanted to. Probably like a 20-minute video. So, Chapter 3, The Anatomy of Crisis. The Anatomy of Crisis. So, crisis being the aggregate and the anatomy, what makes up a crisis. So, the origin of the Federal Reserve System. The origin of the Federal Reserve. So, 1907, sometime around World War One, at the onset of the Industrial Revolution. Because right here it says, on Monday, October 21st, 1907. On Monday, precise a date, right? So on Monday, October 21st, 1907, some 5 months after the start of an economic recession, the Knickerbocker Trust Company. So there's some sort of economic recession going on. It's 5 months into it. The Knickerbocker Trust Company, hence the team, the New York Knicks, the third largest trust company in New York City. So some sort of trust holding. People has to do, it's a financial, right? Began to experience financial difficulties. The next day, a run on the bank forced it to close temporarily. As it turned out, it resumed business in March 1908. So the next day, a run on the bank forced it to close temporarily. It turned out, I think people were taking their money out. So the closing of the Knickerbocker Trust precipitated runs on other trust companies in New York and then in other parts of the country. A banking panic was underway, a kind that had occurred every now and then during the 19th century. Again, that business cycle, the up and down. Within a week, banks throughout the country reacted to the panic by restriction of payments, i.e., they announced that they would no longer pay out currency on demand to depositors who wanted to withdraw their deposits. So, restriction of payments. In some states, the governor or attorney general took measures that gave legal sanction to the restriction of payments. In the remaining states, the practice was simply tolerated and banks were permitted to stay open even though they were technically violating the state banking laws. Like you're supposed to give them their money when they ask for it. The restriction of payments cut short bank failures and ended the runs, but it imposed serious inconvenience on business. It led to a shortage of coin and currency. Coin is just a printing of money. A shortage of coin and currency, as well as to the private circulation of wooden nickels and other temporary substitutes for legal money. So fiat currency. At the height of the shortage of currency, it took $104 of deposits to buy $100 of currency. Together, the panic and the restriction, both directly, it took $104 of deposits. The interest rate is actually, the banks are losing money, right? The panic and the restriction, both directly, do their effects on confidence and on the possibility of conducting business efficiently, and indirectly, by forcing a decline in the quantity of money, turned the recession into one of the most severe that the United States had experienced up to that time. However, the severe phase of the recession was short-lived. Banks resumed payments in early 1908, remember March. A few months later, economic recovery began. The recession lasted only 13 months in all, and its severe phase only about half that long. This dramatic episode was largely responsible for the enactment of the Federal Reserve Act in 1903. So the central bank, which is the Federal Reserve, let me just explain how it works. So if I deposit my money in the bank, obviously, I get some interest off of that for them holding my money, because what they do, that they lend other people money, my money. But every time, let's say if I want to get a loan for $100, right? There is a mandatory, there is a federal, it's called a mandatory. So for every $100 they loan, they gotta put 10% of that into the reserve. So if they lend out $100, they got to put $10 into the central banking system, which is the Federal Reserve, for times of crisis, and made some action in the the fiscal policy. They place the fixed rate. They determine that rate, whether it be 10%, 5%, and hence the creation of bonds, which are the purchases of a country's debt. Um, and that's how they can control interest rates. So uh, I know what I'm talking about. It's just I don't want to explain it. So this dramatic episode was largely responsible for the enactment of the Federal Reserve Act in 1913. It made some action in the monetary and banking area politically essential. It made some action in the monetary and banking area politically essential. During Theodore Roosevelt's Republican administration, Theodore Roosevelt being the During Theodore Roosevelt's Republican administration, a National Monetary Commission was established that was headed by a prominent Republican senator, Nelson W. Aldrich. During Woodrow Wilson's Democratic administration, a prominent Democratic congressman, later Senator Carter Glass, rewrote and repackaged the commission's recommendations. The resulting, he recommends, the resulting Federal Reserve System had served as the key monetary authority of the country ever since. So it has served as a key monetary authority. What do the terms run and panic and restriction of payments really mean? Why do they have the far-reaching effects we have attributed to them? And how do the authors of the Federal Reserve Act propose to prevent similar episodes? A run on a bank is an attempt to many of its depositors to withdraw their deposits in cash all at the same time. The run arises from rumors or facts that lead depositors to fear that the bank is insolvent and will be unable to live up to its obligations. It represents so if I lend you if you give me money, then I lend it out. There's a risk there. I'm thinking, well, they're gonna pay back the money that I owe you, but it's sort of a short. It's kind of shortaging bonds in a sense, because shortaging bonds is it's the same way when they say, oh, they shorted a bond. There's a risk there. You're assuming they're gonna pay you back when this person, hey, I need my money. Oh fuck, I lent it out, and this person's not like this person's having difficulties paying it back. So what? Like that's how recessions happen. So and depressions. The run arises from there's also a demand. The way demand works. There's also a confidence, right? There's like you have a confidence in economic the economic health of how it's functioning. So at the same which hence is the rumors. Rumors affect rumors, right? So let's say like, oh shit, someone's going to be a president and they're going to raise the price on things. So let's buy a lot now. So demand goes up now for things. So that's the confidence of the economy. The run arises from rumors or facts that lead depositors to fear that the bank is insolvent. It represents an attempt by everyone to get his money out before it is all gone. It is easy to see why a run would cause an insolvent bank to fail sooner than it otherwise might. But why should a run cause a responsible insolvent bank trouble? The answer is linked to one of the most misleading words in the English language, the word deposit, when used to refer to a claim against a bank. If you deposit currency in a bank, it is tempting to suppose that the bank takes your greenbacks and deposits them in a bank vault for safekeeping until you ask for them. It does nothing of the kind. If it did, where would the bank get income to pay its expenses, let alone to pay interest on deposits? The bank may take a few of the greenbacks and put them in a vault as a reserve. The rest it lends to someone else, charging the borrower interest, or uses to buy an interest-bearing security, hence bonds. The rest it lends to someone else, charging the borrower interest. So yeah, so I deposit. So how they make money is, oh, I'm going to put my money in this bank, and it makes money over time, which it all depends kind of. So makes money over time, but it sounds like they're giving me money for me using their resource. Well, they lend that money out and then they charge somebody interest. Interest is the price you pay for borrowing money. If as is typically the case, you deposit not currency but checks on other banks. Your bank does not even have currency in hand to deposit in a vault. has only a claim on another bank for currency, which it typically will not exercise because other banks have matching claims on it. For every $100 of deposits, all the banks together have only a few dollars of cash in their vaults. We have a fractional reserve banking system. That system works very well so long as everyone is confident that he can always get cash for his deposits and therefore only tries to get cash when he really needs it. Usually, new deposits of cash roughly equal withdrawals, so that the small amount in reserve is sufficient to meet temporary discrepancies. However, if everyone tries to get cash at once, the situation is very different. A panic is likely to occur, just as it does when someone cries fire in a crowded theater and everyone rushes to get out. One bank alone can meet a run by borrowing from other banks or by asking its borrowers to repay their loans. So one bank alone can meet a run by borrowing from other banks or by asking its borrowers to repay their loans. The borrowers may be able to repay their loans by withdrawing cash from other banks, but if a bank run spreads widely, all banks together cannot meet the run in this way. Hence, a central bank. There simply is not enough currency. So I'm kind of curious what his idea is going to be. I know he's going to be against the central bank. He's gonna explain maybe the cause of why this even came about. So there simply is not enough currency in bank vaults. There simply is not enough currency in the bank vaults to satisfy the demands of all depositors. Moreover, any attempt to meet a widespread run by drawing down vault cash, unless it succeeds promptly in restoring confidence and ends the run so that the cash is redeposited, and forces a much larger reduction in deposits. On the average, in 1907, the banks had only $12 of cash for every $100 of deposits. Every dollar of deposits converted into cash and transferred from the vaults of banks to the mattresses of depositors made necessary the reduction of deposits by an additional $7 if banks were to maintain the prior ratio of reserves to deposits. That is why a run that results in hoarding of cash by the public tends to reduce the total money supply. It is also why, if not stopped promptly, it causes such distress. Individual banks try to get cash to meet the demands of their depositors by pressing their borrowers to repay loans and by refusing to renew loans or to extend additional ones. Borrowers as a whole have nowhere to turn, so banks fail and businesses fail. How can a panic be stopped once it is underway, or better yet, how can it be prevented from starting? One way to stop a panic is the method adopted in 1907, a concerted restriction of payments by the banks. Like holding your money hostage, pretty much. Banks stayed open, but they agreed with one another that they would not pay cash on demand to depositors. Instead, they operated through bookkeeping entries. They honored checks written by one of their own depositors to another by reducing the deposits recording on their books to the credit of one and increasing the deposits of the other. For checks written by their depositors to another bank's depositors, for checks written by their depositors to another bank's depositors or by another bank's depositors to their depositors, they operated almost as usual through the clearinghouse, that is, by offsetting the checks on other banks received as depositors against the checks on their own bank deposited in other banks. The one difference was that any differences between the amount they owed other banks and to the amount other banks owed them was settled by a promise to pay instead of as ordinarily by the transfer of cash. Banks paid out some currency, not on demand, but to regular customers who needed it for payrolls and similar urgent purposes, and similarly, they received some currency from such regular customers. Under this system, banks might and did still fail because they were unsound banks. They did not fail merely because they could not convert perfectly sound assets into cash. They did not fail merely because they could not convert perfectly. As time passed, panic subsided, confidence in banks was restored, and the banks could resume payment of cash on demand without starting a new series of runs. That is a rather drastic way to stop a panic, but it worked. Another way to stop a panic is to enable sound banks to convert their assets into cash rapidly, not at the expense of other banks, but through the availability of additional cash, of an emergency printing press, as it were. This was the way embodied in the Federal Reserve Act. Again, remember, he's cynical of any sort of central government at all. So, uh, and he'll explain. So, mm, through the availability of additional cash, emergency printing press, as it were. This was the way embodied in the Federal Reserve Act. So he's saying this is how this is the origin. This is the orientation the orientation of the Federal Reserve Act. It was supposed to prevent even the temporary disruptions produced by the restriction of payments. The 12 regional banks established by the Act, operating under the supervision of a Federal Reserve Board in Washington, were given the power to serve as lenders of last resort to the commercial banks. They could make such loans either in the form of currency, Federal Reserve notes, which they had the power to print, or in the form of deposit credits on their books, which they had the power to create. The magic of the bookkeeper's pen. They were to serve as bankers' banks, as the U.S. counterpart of the Bank of England and other central banks. Initially, it was expected that the Federal Reserve banks would operate mostly by direct loans to banks on the security of the bank's own assets, in particular, the promissory notes corresponding to loans by banks to businesses. It's like, it almost seems like a bubble that just, I don't know how it hasn't exploded yet. So the promissory notes corresponding to loans by banks to businesses. In many such loans, the banks discounted the notes, that is, paid out less than the face amount, the discount representing the interest charged by the banks. The Federal Reserve, in turn, rediscounted the promissory notes, thereby charging the banks interest on the loans. As time passed, open market operations, the purchase or sale of government bonds. As time passed, open market operations, the purchase or sale of government bonds. So as time passed, open market operations, the purchase or sale of government bonds. What they're doing is they're really just keeping people satisfied, honestly, because the way the sale of government and bonds, I need to strike up supply and demand. This is a system to keep people busy. Um, so if I want to lower interest rates, right, that means I need to up the supply of money, because the bigger the supply of money, that means there's more money out there. So I need to lower the interest rate. So they want that. But if there's less supply of money, that means there's more demand for it, but not enough to give out to everybody. So it becomes more valuable, which I could raise the interest rate because it's a law of supply. Like if there's a big demand for something, it incentivizes me to raise the price. People who suppliers, they want to sell. If the price, they rather sell at a higher price than a lower price. And so in order for me to lower the interest rate, I need to shorten the supply that's actually out there in commercial banks of money. So these commercial banks will buy they will buy my debt. So they're actually giving me, the central bank, they're giving me cash. So there's less cash in their banks, and they're buying my bonds, but they're making money off that bond at a certain percentage of interest rate. So there's an incentive for them to buy it because they make money off of it every year. Depends on the maturity of the bond, which means how many years that bond is. Like a 30-year bond, okay. Uh, that bond is worth $500. Every year I get paid out because I'm making money off that interest rate. So let's say it's a 10%. So I make $50 every year on a maturity of 30 years. And so I could sell that bond. I could sell it. There's other factors involved with that. So if I buy, if I buy, if I'm the bank and I say I'm going to sell you some of my debt, so you give me cash for that debt. Now there's not as much money out in the economy, so the supply is down. There's more demand. I'm like, okay, okay, there's all these people that want this one thing, so I could sell it for higher because of the rarity of it. So that raises interest rates. So what that does, it slows down the economy. Less people are going to borrow. Remember, interest rate is the price on borrowing. But if I wanted to get things going and have the economy working well, then what I do is I buy the debt from the banks, and so now they have more cash in the economy, so that lowers the interest rate. So people borrow more because there's more supply out there. and not as much demand. So to incentivize you to want it, I have to lower the interest rate. The law of supply and demand. So the purchase sale of the government bonds, rather than rediscounts, became the main way in which the system added to or subtracted the amount of money. When a Federal Reserve Bank buys a government bond, it pays for it either with Federal Reserve notes that it has in its vaults or that it has freshly printed, or more typically by adding on its books to the deposits of a commercial bank. The commercial bank may itself be the seller of the bond, or it may be the bank in which the seller of the bond keeps his deposit account. The extra currency and deposits serve as reserves for the commercial banks, enabling them as a whole to expand their deposits by multiple of additional reserves, which is why currency plus deposits at Federal Reserve banks are designated high-powered money or the monetary base. When a Federal Reserve Bank sells a bond, the process is reversed. Reserves of commercial banks decline, and they are led to contract. Because I'm selling you something, so you give me money. So there's less cash out there for people to. Until fairly recently, the power of the Federal Reserve banks to create currency and deposits was limited by the amount of gold held by the system. That limit has now been removed so that today there is no effective limit except the discretion of the people in charge of the system. After the Federal Reserve System failed in early 1930s to do what it had been set up to do, an effective method of preventing a panic. So the Federal Reserve actually failed in the early 1930s to do what it had been set up to do, an effective method of preventing a panic that was finally adopted in 19. After the Federal Reserve System failed in the early 1930s to do what it had been set up to do, an effective method of preventing a panic was finally adopted in 1934. The Federal Deposit Insurance Corporation was established to guarantee deposits against loss up to a maximum. The Federal Deposit Insurance Corporation established to guarantee deposits. The insurance gives depositors confidence that their deposits are safe. It thereby prevents the failure or financial difficulties of an unsound bank from creating runs on other banks. So if one bank fucks up, it's not going to trickle down. The people in the crowded theater are confident that it is really fireproof. Since 1934, there have been bank failures and some runs on individual banks. There have been no banking panics of the old style. Guaranteeing deposits in order to prevent a panic had frequently been used earlier by the banks themselves in a more partial and less effective way. Time and again, when an individual bank was in financial trouble or was threatened by a run because of rumors of trouble, other banks banded together voluntarily to subscribe to a fund guaranteeing the deposits of the bank in trouble. I just want to keep the idea of run. That device prevented many putative panics and cut others short. It failed on other occasions either because a satisfactory agreement could not be reached or because confidence was not promptly restored. We shall examine a particularly dramatic and important case of such a failure later in this chapter. Anyway, peace.